Our next speaker, Mr. Saket Reddy, is an investor in capital markets since 2017 with a specialization in business analytics from Wharton, University of Pennsylvania Online. He is the youngest speaker we have had in any conference till date.
Hello everyone. So the next session is by Mr. Saket Reddy. He's a young chap, and I just read about him on Twitter. I saw his post, and we were discussing internally how he's finding stocks, and we asked him to see if he can cover. He is following fundamental analysis as well as technicals, and he's trying to he's picking the stocks in mid cap segments. So we asked him if he can present. He was kind enough to, accept that. So thank you, Saket.
Hello, sir. Thank you very much for the opportunity, sir. It's an honor to speak at EDECMA 2021, sir.
So Saket, tell us about how you started investing.
The first when I started, sir, as you know, we were in a big mid-cap, small-cap bull market. So I started in 2017 November. So then I don't know anything about fundamentals or technicals or anything. I used to see some TV channels and used to put money in some stocks. Then 2018 came, but luckily I was not invested in stocks that were that went down 80% or 90% in 2018. But it took a good hit of 30% or 40%. Then in 2018 I became clear that we need to learn something about the market. Then I started learning about fundamentals mostly. I started reading research reports, started looking for materials out there. Then I understood something about fundamentals, but not too much about the. I looked for the business profile of the company instead of the operational performance. That was the main problem in 2018 for me. Then I slowly stopped that. I went on to intraday trading. With Zerodha used to offer that time 14 times for intraday trading, 14 times the average. Then I did that. So once I used to get profit, the next so it would be like 5-6 days I used to be profitable. The next day everything used to go. So I blew up some accounts there sometimes. A full account. Then in 2019, someone told me about options. So if you allocate properly position sizing, you can make money actually in options. Then I tried options. I made good money in options. I don't know anything about options, but I made money in options. But again 2019, just before the Pulwama attack, I put money in Axis Bank. I bought a call option basically, and I lost entire money there. Then I started learning about options. I didn't know option selling then. I knew only option buying. Then I thought this was not for me, so I left it out. Then I took a break for around 6 months. 6 months. Then I started studying about fundamentals, operational performance, the complete profile of the business, and all. Then eventually I came to Twitter. To 2018 or 2019, I came to Twitter. The first of the few profiles I followed was AP sir, Abhijit Pathak sir. You know him, right? So then he used to tweet these noiseless charts on straddle charts and strangle charts. And I used to not understand what are strangle charts and straddle charts. So I used to not bother. Then one day he tweeted about a Maruti call option chart, basically the point and figure chart. Then I understood something about point and figure charts. And slowly I started learning both fundamentals and charts. Then again I left it out. Again I sort of 2019, when the corporate tax cut was announced, I became again a euphoric guy, and I invested in around some bad businesses, and same thing repeated again. Then what I did was, in 2019 December, I bought a book, the P&F book. So I read it completely. I read it twice. I read it thrice. Then I understood more about P&F charts, how they work. Then I observed that these charts are very good for identifying medium-term, long-term breakouts. They do really well in giving a good entry point. So what I did was I mixed this and I mixed my fundamental knowledge, both. Then what happened was, luckily I found a US-based fund manager named Chuck Acre and some other fund managers who follow the same philosophy. I like the philosophy. I tried what happens if we do this in India. Then I found some great companies. So I thought this is good. These are good companies, high quality companies, mostly consumer companies. We all use their products every day. Then I thought this is a good thing to do. Let's try it and see. Then I entered 2020 by doing this. In March, we all know what happened, but these companies saved me. The drawdown was half of what of Nifty happened, around 20% drawdown in March. So these companies saved me. These companies did really well that time. These companies are doing really well now as well. Of course, some people comment on PE ratio and all, but one thing I learned is it's an optical illusion right now. So I've stopped bothering about PE ratio and all. So yeah, I mean, it's going good for now. We will learn more going on.
Yeah. So we are very excited, and I will keep this session kind of casual, informal. I'll keep bothering you, but we'll divide it in two parts. You can first talk about the strategies that you are following. I'll mute myself. Once you are done with your strategy, then we will discuss about it.
Yes, sir.
So so I'll hand it over to you first. You can start with your presentation.
Yes, sir. So hello everyone, I am Saket. So as you can see, the title of my presentation is Medium Term Quality Low Volatility Investing. So first I'll be talking about quality, then we'll go on to low volatility, and then we'll talk about the technical aspect, that is noiseless charts. So first, the standard disclaimer: not a SEBI registered investment advisor, and any stock discussed here should not be considered as an investment advice, and I may or not have an vested interest in any or no stocks discussed in this presentation. First, we'll talk about quality. So if you take an NSE, in National Stock Exchange, if you consider a market cap of 500 crores, if you consider companies above market cap of 500 crores, we have around 1,000 companies. So we cannot keep tracking 1,000 companies at one go. it becomes very difficult to track their fundamentals, to see their charts and all. So what do we do? So what do I do here is I cut down the 1,000 stocks into 100 stocks. Now how do I do it? So here is a simple fundamental framework that is set out by Mr. Saket Reddy. He's a US-based fund manager. He runs a mutual fund. So the first thing which we see here is the company should have high return on equity and high free cash flow generation. What is free cash flow? Free cash flow is basically cash flow from operations minus the maintenance capex that the company does. So all the points here may not be ideal for an Indian company. Just to make sure that you understand, most of the Indian companies are B2B businesses. So some of these points may not be valid, but most of these points, such as the ROEs, free cash flows, and strong balance sheet, that means low debt and good gross block allocation to on a long-term basis. Coming on to management. What management is? Basically, we need managements who are prudent in capital allocation, who do benefit to their shareholders in form of dividends or buybacks in a sustainable manner, and who do not show any bias towards minority shareholders. That's on the management. Number 3 comes reinvestment. Reinvestment is the most important part. What is reinvestment is basically the company earns free cash flow. The free cash flow should be further reinvested into the business itself. The most of the free cash flows should not be given out through dividends or through bonus or a split. Most of the free cash flow should be reinvested back into the business. So the business, which already has a higher ROE, as you can see in the table number 1, will generate more earnings for the company at the same ROE. That would mean the company would grow at a much higher pace than its peers if it reinvests the cash flows at a sustainable basis. So if you mix these 3 components, you will form a compounding machine. So basically, if you look at examples like an Astral Poly or Supreme Industries, these companies have strictly followed these 3 parameters, and hence they are compounding machines now. That will be mostly our fundamental fundamental framework that you can talk about. So this would, if you look at some kind of a screener or any ticker tape or any website, if you put these kind of filters, you will get around 100 companies from Nifty 500. So out of the 100 companies, if you will take out some, we will talk about that later. Now, in every sector, there are these unseen compounding machines that we do not get to see in TV channels or anything. So, but if you see in the table, if you see the column number 2, the uncovered underperformer. So these kind of companies are often discussed in TV channels. Often their managements are often seen in media, or many blogs are written about them. But if you see the third column, these are the compounders that not many talk about. These are boring companies for people, for traders, or for media channels as well. Their managements don't come out. They are very silent in the nature. If you look at tires, many people talk about Apollo Tires and JK Tires, but the real wealth creator has been Balkrishna Industries. Same with chemicals, Sudarshan Chemical, Noiseless. They're great companies, but if you look at on the other side, we have companies like PI Industries or Atul Limited. No one talks about because of the share price. They think the share price is high, so we cannot buy more number of shares. Same with banks. In the mid-cap banks, you always see RBL, Bandhan, and all. They talk about Bank Nifty, RBL Bank, Bandhan Bank, and all. But City Union Bank has been the biggest wealth creator in the banking segment, even more than HDFC Bank and Kotak Bank. Same on other sectors, as you can see here. Then we come on to the most important part. How do we find them? We put a screener or a filter or a ticker tape screener. So what traits do a high quality compounding machine has? So what these high quality compounding machines, what they do, what their promoters or what their managements do is they invest capital, they turn that investment into sales. That is, normally they sell their products. Then the sales convert into profits, which is good margins and operational efficiency. They come into your hands as profits. Now these profits with prudent working capital management, they come to your cash flows. These cash flows go into your balance sheet strength in the form of either debt reduction or fixed assets being increased in capex. What happens after all these is your free cash flow is the remaining balance that you have after retained earnings, after everything. Now, if you reinvest this free cash flow again, instead of giving out completely in form of dividends, you reinvest the cash flow back into the business. If you reinvest the sixth point, if you take it to the second point once again, the incremental capital that you reinvest, that will generate the same returns as your previous investment. So you're essentially increasing your returns to the shareholder. That's what these high quality compounders do mainly. This reinvestment could be of any form. It could be of a buyback. It could be of a capex. It could be of an acquisition of another company. So that's the more of a fundamental. This is more of a quality approach that we're talking about. Now, there's an interesting quote here: the least hit will recover the first. So you can take the quote as a relative strength study as well. The least hit will recover the first. So now coming on to the second part of my title of the presentation, low volatility. What do I mean by low volatility? So if you look at the table here, we can take player A as Virender Sehwag. We can take player B as Rahul Dravid. So if you see, both Virender Sehwag and Rahul Dravid have an average of 43 and 40. Both are very good players. Both have an average of 43 and 40. Now, if you put these scores in an Excel sheet and if you calculate their standard deviation. Now, what is standard deviation? Standard deviation is it's basically a metric that measures how far is each score of these batsmen away from the average score of the batsman. Now, if you go into the second table, so Rahul Dravid's standard deviation is around 31, and Virender Sehwag's standard deviation is around 43. Now, Rahul Dravid's standard deviation is low. Why is it low? Because his scores are very consistent. If you look at the matches, apart from match 1 and 3, he scored good 11 and 18, 90, 40 and 37. Whereas coming to Virender Sehwag, in one match he scored 112, in the next match he scored 3. So it's a lot of volatility in his batting approach and his scores in the matches. So as and when the standard deviation goes down, the volatility of Rahul Dravid's scoring runs comes down. So the probability of Rahul Dravid scoring more runs and scoring good runs goes up. That's the basic low volatility meaning. So the movement would be low, but this low volatility will help you very much in the long run. We will see how that will do. Now, how do you filter low volatility stocks? First is ticker tape screener. This is a screener made by Small Case. Many of you know Small Case app. If you don't know, you can just put it under. If you go to Zerodha, you can find Small Case as well. It's their screener app. There, if you go to technical option, you will find the low volatility. If you find the low volatility of the Nifty, which is basically a measure of standard deviation that is automatically put out for you. Second one is a bit of a tough approach. Old school guys can do it. You download historical open high low close data from NIC and you can compute the data in Excel sheet. That is a bit of a long approach, but anyone can do it. The third one is very interesting approach. Third one is there is basically an index called Nifty Low Volatility 50 Index. So what it does is every 6 months it takes list of top 300 stocks of Nifty, and it does the same thing that we do in the top 2 things, and it basically computes a list of 50 stocks, the lowest volatile 50 stocks, and puts them in an index. This is not known to many people, but if you go to NSE Indices website, you can find it there. You can get the index components as well. It will come in an Excel file, and you can take a list from those files as well. Now, the main part: how can low volatility help you create alpha over the market? So, what is market? Our basic idea would be to beat the Nifty or to beat any benchmark that we put for ourselves. Why does low volatility matter? The first. Now, this is one thing that many people not fail to understand, but they don't try to understand. So let's say if stock loses 10%, let's say it goes from 100 to 90, then the same stock, for it to come to from 90 to 100, it should gain 11.1%. That means 1.1% extra from the low base. Same with the stock. If the stock loses 50%, from 100 to 50, it should gain from 50 to 100, should go back 100% to go back to 100 levels, to go back to the pre-levels. Same with the 80% loss. Now, what happens here is a low volatile stock, it goes down less, and when it comes up, it can get back to even at a much quicker pace than the high volatile stock. And there's a quote here: over the longer term, it can be harder for a high volatility stock to make back what it's lost. So this is a very important approach for low volatility investing. One needs to understand why low volatility as a factor can help you in gaining alpha over the index. This is just an example. Nifty basically managed by NSE. So NSE indices has an index called Nifty 100 Low Volatility 30 Index. This index, we have an ETF for it, and it's managed by ICICI Mutual Fund. So this is just an example. So if you see, this is a 2020 chart, basically, what we are seeing here. So this chart, if you look at the orange line is the Nifty 100 Low Volatility Index. The green line is the Nifty 50 Index. So this Nifty 100 Low Volatility 30 Index consists of 30 stocks versus Nifty 50 consists of 50 stocks. So what happened here? From the starting of 2020 to March 23rd, that's usually the bottom of the COVID crash or whatever you can call it. The Nifty fell around 40%. The drawdown of Nifty was 40%, whereas the drawdown of Nifty 100 Low Volatility Index was 30% only. It fell less 10% than the Nifty. But after March 23rd, till date, the Nifty Low Volatility 100's performance has not been greater than Nifty. It has been subtle. It's been okay. The upside capture of Nifty 50 versus the Nifty 100 Low Volatility is more than 100%, whereas the downside capture is higher than 100%. So what this tells you is you should underperform. You should outperform in a fall, but even if you underperform in a rise, even if you underperform in an uptrending market, it will not affect you. You would still be higher than your benchmark. The same has happened with Parak Mutual Fund. That's a great example of a low volatility investing. Parak Mutual Fund basically is a flexi cap fund. Many people know it. It's become a popular fund now. What happened? Let me give a small example. It's a very short-term example. These short-term price movements can help you gain more of an alpha. What happened was, in the budget, the pre-budget fall that we had, the before week of the budget of 2021, Nifty fell around 8%, whereas Parak Mutual Fund fell around 2% only. And the day after the budget, the day since the budget, Nifty rose. Nifty completely reversed its fall and it came up. But Parak Mutual Fund, in the first day of Nifty's rise, that is on the budget day, it recovered all of its losses and it went to an all-time high back again. And it's still outperforming the Nifty. So these are the small outperformance, the upside ratios that can help you beating your benchmark for a longer period of time. This is just an example. Now, this is the main thing here. So we've covered quality, we've covered low volatility. Quality will help you reduce your fundamental coverage. Quality will help you get your stocks correct. Quality will help you identify great stocks. Low volatility, what it does is, why we are using low volatility here is because in the quality framework that we discussed, sometimes we get these high volatility cyclical names. For example, if you put that filter there in a screener or any filter app or a website, you would get stocks like HEG and Noiseless or Sudarshan Chemicals. Now, these are high volatile cyclical stocks. So we don't want to go there. So we choose chasing low volatility. Now in low volatility, the same sector will get a different bunch of stocks. That's the reason why we're choosing low volatility. Now, what can Noiseless chart, that is basically P&F charts here, can do for the above methodology? First, they will give you a perfect entry point. Not a perfect entry point, but a good entry point for entering the stock for medium term. Now, what we want to do here is, these are simple rules. There's nothing complicated here for a beginner to understand P&F charts. So what we do is we take out stocks from our fundamental coverage universe that we have created in the first slide. We put out those stocks there, and we go to the TradePoint website or any website, and we look out for charts on a 1% box size chart or a 3% box size chart, or it can be 0.5% box size chart as well if anyone wants to do it. So we are basically chasing for medium term entries. So 0.5, 1 and 3 would be an ideal point. We look for positive column reversal, that is an X column coming after no column on a subsequent trading day, or a double top buy that has been triggered already. So what we do here is, we take stocks from our fundamental coverage universe, and we look up and we plot them on a 0.5% or a 1% or a 3% box size charts, and we look out for recent positive column reversal, that is an X column after an O column that has been formed on the preceding trading day, that is on the trading day or the EOD chart that we look mostly. Or we are comfortable also with a double top buy that has been triggered on the preceding trading day. We go out the next day and we enter those stocks. Now, once the entry is done, some people would be like, we like to do SIP in the stocks. So this is a good way to enhance your SIP returns. So I've created two basic rules here. What they do is, first rule, let's say Mr. A wants to do an SIP in his portfolio, in the current portfolio that he has bought using the previous frameworks. Let's say he wants to do an SIP on 1st of every month. So what I would recommend him is, on the first rule, on 31st of every month or on the last trading day of every month, open your portfolio, put all your stocks on one side, plot the charts of all your portfolio stocks, and make a list of those stocks that are either trading above double top buy level, that are either trading at double top buy level or above double top buy level, or have recently formed a positive column reversal, that is are subsequent to a double top buy level. Make this list of stocks, and also make a list of stocks that are at a DBS, that is a double bottom sell, or have formed a O column recently in the preceding month. So once you put in an Excel or any other form, all these parameters that we just discussed in the rule number 1 and 2, you basically what you do is look out for, filter the stocks that are either at a DTB or a PCR, positive column reversal. Take the list of those stocks, even if it is 1 stock or 5 stock or 10 stocks, all your stocks. Go out there, do an equal amount of SIP in all those stocks. What it essentially does is, in the first 1-2 months, you will not feel any difference. But after 6 months or after 1 year, you will basically shove out all your losers and you will back your winners all the way. You will keep adding money into your winners. So this bit of a momentum style as well. You will back your winners all the way. You will shove out your losers. That is, you will decrease your weightage towards the loser, towards the underperformers, and you will increase your weightage to the winners. That's the basic rule for this thing. Now, when to sell? Many people ask the question when to sell. Even on Twitter, many people ask the question when to sell. I only post buy charts. First thing, exit the stock if the company reports less than 5% YOY growth, that is EPS growth or profit growth, for 2 consecutive quarters. Now I mentioned here operating profit growth. Why I mentioned this? Because some companies, like if you see SRF numbers this quarter compared to last quarter, you will have an operating the tax refund that SRF had got last quarter. So that's a mismatch for you. So always see operating profit growth and EPS if the growth is less than 5% YOY, year on year, for 2 consecutive quarters. Exit the company, don't think anything. I've done the same with Fine Organics in October 2020. I've been very happy selling the company. Second thing, when you want to sell, when it forms a double bottom cell, 3% box size chart. Why not 1% box size chart is because you get many double bottom cells on 1% box size chart, and we want to keep the churn ratio as low as possible. Why as low as possible? Because these are good quality companies. They may face short-term corrections, but they will eventually bounce back. That's the idea when to sell. Thank you very much.
Excellent presentation. Excellent presentation, Saket. I must appreciate your presentation skills. It was wonderful, and you were to the point and flawless.
Thank you, sir. Thank you very much.
Yeah. So I have, some questions on 3 or 4 points that you talked about. First, you talked about quality companies, right? And the
Yes,
companies that typically reinvest their free cash flow. So
yes,
and also that you're saying that growth in the operating profits basically, right, for consecutive 2 quarters.
yes, yes.
So any objective screeners that you use on any website, but anything that you use for finding these companies?
Yeah, so first I didn't know about any screener. I didn't know about such type of filters or screeners existed in India. In US they exist, and I used it for US stocks as well. But here I didn't know anything at first. So what I did was I went to a website called Screener only. I went to Screener first, but I didn't know that we could screen stocks there. I only thought it was a platform for knowing about the stocks fundamentals and all in one place instead of going through all of its quarterly releases and all. I thought it was only a platform for knowing what companies doing in terms of its operational performance. I didn't know much about the screener.com. That's the website. I didn't know what was it before. So what I did was I made a list of I downloaded a list of Nifty 500 stocks from NSEindices.com, and then what I did was I went to the screener.com. I opened every company's list. I put out 2 columns in Excel. This ROE growth, free cash flow, and earnings growth over last 5, 10, 3 years. So I did it manually for all 500 companies. So that's how the first base came. Then in the next subsequent months, I got to know that there were many other apps that were allowing you to screen this automatically, such as we have Ticker Tape. Ticker Tape is an emerging app. We don't have longer term ratios, but Ticker Tape gives you more insight into cash flow growth, operating cash flow growth, and all. And then we have Screener.com, which we can do this thing. But what I've done basically is I manually filtered down these stocks. That time, because I didn't know that there was an automated app for this. So I got around 80, 90 companies. I have stick with those companies. But after these filters came, after these automated apps came, I found out more companies as well. That's how it is.
So when you manually did this, which parameters you basically looked at?
So what I looked at was ROCE, 3-year, 5-year, 10-year, and 7 years. Basically, I just copy pasted it, the table, for all companies. Then I looked for earnings growth. That is, earnings growth is EPS growth, or it could be profit growth as well. Then I looked for operating cash flow growth. Operating cash flow, the numbers for over 10 years, and how is it growing in line with the EBITDA, in line with the profit? Is it growing in line? The working capital management, working capital management of the company, that gets filtered out there. Then I looked at free cash flow. Free cash flow, we cannot get it on the website. So basically, I did an Excel filter for that. Operating cash flow minus the maintenance capex. So that's how I did it in Excel.
Nice. So you said you look for operating profit growth compared to EPS. Any particular reason why you do that?
So yes, sir. The reason is sometimes in some cases, because of the recent corporate tax cut that we had in 2019, some companies got MAT credit. MAT, that is a MAT, that's a tax. They got the refund for that. Some companies. So what happened here is some companies like Naveen Fluorine that got a tax refund in Q2 FY20 as well. I think same for SRF in Q3 FY20. These companies, so if they got that is mentioned under other income, or it's mentioned under tax refund. in the earnings. But in the screener app, you will get it as same thing. You'll get it as tax refund only. But the underlying EPS growth increases. The EPS number will go higher. It will look elevated for you because at the end of the quarter, the company earned more because of tax refund or because of the operations. That's the reason I look at operating profit, because operating profit is basically the dhanda of the business, the
Yeah.
dhanda of the company. The business it's doing, it's getting the operating profit. That's the reasons.
Nice. Can you go back to the slide, your third slide? I mean, you mentioned about some sectors and the stocks.
This one.
Yeah, yeah. So you said some companies, for example, in banking sector, examples, UB did better than RBL or Bandhan Bank. Anything that you remember how you could find these kind of stocks in those sectors? I mean, maybe your past example, your experience, that could be okay. But anything that you can mention that these were the factors, and because of that, these stocks could have been bought or could have been traded. Anything like that?
Yes, sir. Yes, sir. Suppose if you look at the FMCG sector, I'm talking about ITC and Godrej CP versus the Varun Beverages, that's the bottler for PepsiCo in India, and Marico. So what's the difference between these two categories is ITC had huge cash flows. ITC is a cash behemoth, cash cow, but it did not have the, what can we say, it did not have the scale. The size of ITC is too big that until and unless it doesn't big acquisition or something like a HUL did to Glaxo this year itself, in last year 2020, uh, nothing of that sort of size of ITC's cash flow can be reinvested elsewhere. So ITC's reinvestment rate is low because it's 80% or 70% of cash flows are given out as dividends. Same with Godrej CP. Godrej CP is a volatile FMCG company. It's diversified internationally to Indonesia and other areas where it's not performing well because the Southeast Asians mainly prefer their homegrown brands. And Godrej CP's management is highly volatile, I feel. So that's one reason I kept those aside. Coming on to VBL and Marico. Varun Beverages, uh, corporate governance is no doubt. It's a great group. RJ Corp is basically not known to many people, but RJ Corp is the bottler for PepsiCo in India. Is the retailer for Nike in India. Although Nike is not in the listed entity, but it's also the 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 franchisee of Pizza Hut, Burger King, not Burger King, Pizza Hut and KFC in India as well. So on the corporate governance side, VBL has no issues, and VBL is a slightly small company, almost half of Godrej CP size, I guess. They've got high reinvestment ratios. They've got high, what can we say? They got high scale of reinvestment because VBL is only bottler in most of South West India and most of North India. They are yet to capture Southeast India, that is Telangana, Tamil Nadu, many places, and they're also expanding in the Indian subcontinent, that is Bangladesh, Nepal, Sri Lanka. They are expanding. So Varun Beverages is one company, and many times the thing is you don't see Varun Beverages anywhere except in the Nifty FMCG index. Management never comes out. You will not see the company anywhere. Same with Marico. Marico often it's seen sometimes as an F&O stock, but same with Marico. Recently, it updates reinvestment rates due to its reinvestment, due to its focus on Saffola. That is, it's entering into the premium segment, premium cooking oil, premium hair oil, premium oats, the cereals that you eat. So that's the case of Marico. Same with pipes. Pipes is a very interesting sector. Phenolics pipes has been talked more about because of its PE ratio. Trades at 20 times versus Astral Poly that trades at 120 times. Why this difference is because Astral Poly reinvests around 80% of its cash flows back into the business every year. They enter a new business line every 5 years, and they become the leader of the business in that new business in every 10 years, basically. So 2015 they've entered adhesives. Now they are competing directly with Pidilite in the B2C adhesives business. Now they're entering water tanks. 2021 March they will enter water tanks business. That's a basically Syntex is bankrupt, as you know. So Astral Poly, that's one thing. Same with Prince Pipe as well. Prince Pipe is a very small company. It has got that thing in it. It's a very small company. It's a recently listed, recently IPO company. but it cannot compete against Astra and Supreme Industries because both have their homologue set on the industry. That's one thing. The same with if you see metals. Metals very interesting. If you see Tata Steel and Hindalco, both are great companies. Both have great parentage in Tata and Hindalco in Aditya Birla Group, but both are volatile against commodity prices. Very cyclical companies. If you come to Hindustan Zinc, no one discusses it anywhere. Management won't come on TV anytime. And for the fact no one knows, it's not an F&O stock, but its market cap is above 1 lakh crore. It's the 30th largest company in India, I guess, and largest listed company in India. And what different for this company is, so 30% of Hindustan Zinc revenue comes from silver, and the rest comes from zinc and lead. So let's say in the commodity downturn, demand is going down. So lead and zinc obviously will go down because they are metals and they are linked to the global economic cycle. But if these go down, silver becomes a hedge for them. Silver rises. Same happened in Q2 of FY21. That is the previous quarter that we are in now. That's the previous quarter. That is around September ended quarter. Silver became the savior for Hindustan Zinc earnings. And once the industry comes up, once the opening up happened, once global economic cycle is in upturn, the reverse happened. Silver was flat, lead prices went up 20-30%. Hence, Hindustan Zinc balances this beautifully that it's a debt-free company in metal sector. Hindalco and Tata still have more than 1 lakh crore debt, I think not 1 lakh crore, around 60-70,000 crore debt, which is equal to the market cap. Hindustan Zinc is a debt-free company, high cash flow company, gives out around 40% or 50% of profits are given out as dividend. Other than that, great company. Same in infra. Dilip Buildcon is highly discussed because 2017, just when entered the market, the Bharat Mala project was announced. That time, Dilip Buildcon got the highest orders in Madhya Pradesh. Same with Gayatri project. I think it's a Hyderabad-based company. It's highly discussed in TV channels, highly manipulated stock. I feel Gayatri projects. Then come to KNR Construction, PNC Infra. No one talks about these companies. Management does not come at all. But every year on year, they've got the best ROC, best growth, best cash flow generation in their industry itself. Of course, if you take out L&T from the pack, KNR Construction, PNC Infratech, the results were put yesterday. They were blockbuster results, and no one spoke about it. Stock quietly went up 20%. When today it's up 9% again. No one speaks about it. And KNR Construction is one more good company, chooses projects. This is one company that chooses projects on its own. It does not go to anywhere the tender is available. It chooses projects, it chooses where it wants to go. And both have very low debt. So essentially, these third category, debt and reinvestment rates are the biggest filters.
Yeah, so debt and reinvestment you said. See, at times what happens, Saket, I mean, after finding outperformers, it is kind of hindsight that we can go back and find out the reasons why some particular thing happened. But if we want to continue to do well or for the repeated success, it is important that we have some process in place, and we look for some factors, so that we can set up some process, some rules which we will follow in future as well. So I was looking for those kind of factors in your process of finding the stocks. So I think reinvestment is one thing that you talked about. Of course, you also mentioned some other points in your like you look for the ROC, you look for the growth in the profit margins, and you look for the low cash ratios and free cash flow, and the debt is also a factor. All right. Then you talked about kind of outperformers, I would say relative strength, but there's also a technical side of it. But of course, it is, in my experience also, it is a very useful tool when we look for the investments. Okay, and then you talked about low volatility, and there are two things that you talked about. One is standard deviation. So standard deviation, of course, I think it is available in every software out there. It is there in TradePoint as well. If you calculate it in Excel, which if you have done it ever, which parameter you look for? How do you calculate standard deviation? Because you can calculate it for multiple periods, right?
Yes, sir. We basically move to formulas in Excel. Then we have the STDEV, the standard deviation, the basic formula for it. You click equal to the formula, and you click. You put all your closing data, not OHLC data, but only your close price of the stocks. You will get the standard deviation data.
For example, if you calculate it in Excel, so falling standard deviation is falling volatility, and rising standard deviation is rising volatility. We can call it a parameter for volatility, right? So,
Yes, sir.
first of all, you plot standard deviation for what parameter? Do you look at it on a daily chart or a weekly chart? And if on daily chart, for how many days?
So basically what I do is, we have talked about one example here, that is the Nifty 100 low volatility index. So once if you go to the Nifty indices website, and if you go to the index methodology, they've set it up in a separate file, I guess. There's an index methodology PDF that you get. So they've laid out some rules for what should be the standard deviation measure and all. So I followed that. So what it said was, they said the standard deviation we take for 200 trading days. Now, why 200 trading days? Because what their thinking was is, in a 365 days of calendar year, there are approximately 200 trading days. So they take out 200 trading days of standard deviation of all the companies. So this is one part. Other part, the main part here is, once we take out the standard deviation from the 200-day standard deviation of all the stocks, so NSE follows the processes. NSE computes the list of all their coverage universe stock, Nifty 100 or the top 300 stocks based on the two indices. Then they keep the ascending order of all the standard deviation measures of all the stocks. The bottom 30, the least standard deviation of the least 30 stocks or the least 50 stocks based on the two indices, they are considered into low volatility index. But what I do is, what I follow mainly is, I compute Nifty's standard deviation measure first. It's around 19 or 20. You will get it in the fact sheet. You don't have to calculate it. You will get in the monthly fact sheet that NSE provides. Then we compute the standard deviation of all our portfolio the fundamental coverage framework that we designed of all those stocks. Then whichever is higher than Nifty, they're considered as higher volatility stock. Whichever is lower than Nifty, they come under low volatility stock. So these can change anytime. So on a semi-annual basis, we can keep on checking these filters again and again.
So you look for standard deviation, 200-day standard deviation of Nifty. Then you look for 200-day standard deviation of your portfolio stocks. If that standard deviation is lower than the Nifty standard deviation, that is your universe for the low volatility stocks.
Yes, sir. So basically, what happens here is, we have NSE provides us OHLC data, and some other third-party apps, third-party websites like investing.com, Yahoo Finance also provide us data, OHLC data. Sometimes we do not get that exact 200 days for 1 year. We get around 220 or 230 sometimes. Sometimes we get 190 or depending on the holidays or something like that. So that's something we have to keep an eye on. It's not 200 exact days. Sometimes we get more, sometimes. But the main objective is 1 year of standard deviation data.
Understood. And you said the low volatility index. That NSE provides, right?
Yes, sir. NSE, there's NSE indices website, so it's got factor indices. Factors, right? The value, momentum, this low volatility and alpha. So these are broadly the factor indices that NSE provides. One of it is low volatility index. It's got two indices. One tracks Nifty 100, that is top 100 stocks. One tracks the top 300 stocks. That's it.
Yeah, it's a very interesting point, because even it is available in our software also, and I also regularly look at these kind of indices like Nifty Alpha. Then there's a quality index, quality 30.
Yes, sir.
Then quality 30, which looks for the stocks in Nifty 100. And then quality
Nifty 100 and Nifty 200, both have their quality 30.
Yeah. So this low volatility is interesting. The thing that you talked about. So you look for your fundamental picks in those low volatility index. Basically, that could be one good process that one can look for. Then we talked about noiseless charts for entry. No,
Yes, sir.
so there are two things basically. One is either you look for the column reversal or double top buy in 1% box value.
Yeah, 0.5, 1% or 3%. It does not matter mostly for us.
So typically when you look for the mid cap or or small caps, the 1% or 3% could be very favorable. Can very useful box value.
So the higher the box size, the what I've seen is the higher the box size, the better your success rate.
Okay.
Just like the higher the time frame in candlestick chart, the higher the accuracy. Same for the higher box size as well.
And then you look for company has reported less than 5% growth in the profit margins for consecutive 2 quarters, right? That is one exit criteria. And second is
Yes.
double bottom sell in 3% box value.
Yes, sir.
Have you seen that price has given a double bottom sell in 3% box value, and there is no indication on your fundamental screeners, or have you experienced something like that?
Yes, there has been a case. So in this recent case only, it's I think last quarter itself. About India was one of my largest holdings, almost since the beginning when I started this, and it had massively underperformed Nifty last you could say 1 year as well. So it hit at DBS, it hit at double bottom sell. I exited out of it. No change in fundamentals. Absolutely no change. High quality company showing earnings growth still, but no change in fundamentals. I sold it out. It fell 1,000 rupees more. So that's one company. And one on the second rule, if you come to the first rule, Fine Organics is one company.
So how do you feel while exiting? Because there's no indication the company and everything is same. I mean the fundamentals are also good, but just because price is falling and there is a bearish signal, do you feel comfortable while exiting? And how have you got that kind of confidence?
This is a very interesting question, sir. So what I found in these companies is, in these type of companies is, sometimes they go into a huge time bound corrections. 3 years, 5 years, 6 months, it could be anything. But we cannot figure that out. Same with ITC recently, it's gone to big consolidation. Same with Hindustan Lever in 2004. I've seen the charts. Same with about India itself. Same with it in 2017. So when I entered the stock market, the first high price stock I saw was about India at 5,000. But I didn't know what was it then, so I entered it at 15,000 only. So these stocks go to time bound correction. The price bound correction is very low. The 20% correction maximum, but time bound correction is very high. That sometimes we lose our patience. We lose our patience in it. Same what I lost my patience in about India most of the times. Then in Honeywell also, it went to big time bound correction, then started a big rally. So these stocks, they go to time bound correction. We don't know when they will enter the time bound correction. We exit it, it's not a problem, sir, because even if it goes higher, we've got other stocks. Or if it enters a time bound correction, then we cannot expect it to come out of that correction.
Interesting. So do you book profit? Do you have any rules for booking profit in technicals, or how do you do that?
Booking profit, sometimes I let it run most of the times, but sometimes we want to book profit if we feel the valuation is getting too much punchy, or the stock has gone without any reasons. An example is alkylamines. Recently, when some of that split, it went from around 4,000 to 5,000 or levels. Sometimes if those things happen, like what I can say is, if there is no impact on the business, but if there is no news on the business, but the stock rallies, sometimes it's okay, it's prudent to sell some of your holdings. That could be followed, but I don't follow that. I just let it run. But yes, if I want to invest in a newfound stock, or if I'm confident about one or the other stock, I usually trim the holdings. or if you say, let's say I hold a 30 stock portfolio, and usually what I follow is equal weighted portfolio, 3.3% for every stock. And let's say stock like India Mart, it's a real example, the weightage has gone to 6% now. So there's nothing wrong in trimming down that 6% to again 3.3% and averaging out your loser sometimes. But that I'll do, sir. If the weightage has gone too much high, I will bring that down and get the lower weighted stocks. So what I do is, let's say I hold a 30 stock portfolio, and what I follow is I follow equal weighted strategy, equivalent to all stocks, so 3.3% to every stock. Then let's say the stock doubles, or let's say the stock moves very much higher, so that the weightage goes from 3.3% to 4.5 or 6 or 7%. So then sometimes what I do is I sell that additional weightage. I bring the weightage down to 3.3%. And for the stocks whose weightage has gone down, not because of underperformance, but because this stock, the particular stock that I'm talking about, has rallied so much that it has made the other stocks to come down, the other stock weightage to come down, I will be comfortable to increase their weightage to back to normal levels, 3.33% levels. So that could be considered as a profit booking strategy also.
Saket, do you follow stop loss, price-based stop loss, or any kind of stop loss?
Stop loss is basically 3% DPS only, sir.
Okay, so you put that in system for your portfolio, or you track them, right?
Yes, sir. What I do is normally we basically, if you follow this process, we don't need to look at the stock price every day. So what I do is, what I or one of my family member has so one of my family member also tried this strategy. So what I told him was, you don't look at the stock price every day. Look at every week. On a Saturday or Friday, you open it and then you see. That's it. So what happens there is, every week we do this calculations. So where is the DBS, what is the stock doing on the chart, what happened to the results and all. So every once in a week, if we see, it's okay, sir. What I designed here is, it's a low churn sort of a passive strategy. You don't need to look every hour, every minute into what it's doing, what that's doing. It's an end of day charting. We follow end of day charts. So looking the stock price end of day is not a bad idea.
So, for example, you look at it after a week, and what if there was already a double bottom sell signal? The price is already fallen after that, so you exit at the end of the week.
Yes, that could be a good idea, but no. What a case study I gave here is, so my relative who's following the strategy is very he's a tensed person. So, for example, Biocon is a stock in his portfolio. So that from 450 it went down to 380 or 390, 370 actually. That recovered to 420 again today. So he asked me, what should I do? What should I do? And I told him, you don't see this every day. If there's anything, I'll tell you. So you don't get bothered. That's the way I put it. But sometimes if there is a huge destruction in the price, huge correction or anything, we can open the chart and we can just check it out. Or we can do one more thing, sir. In Zerodha, I don't know about other brokers, there's a thing called Sentinel, where it shows you if you put up the price, it shows you whether the prices come or not. It's basically like an alarm. So if you put the price, let's say Balkrishna Industries will hit 1700 is your alarm. Whenever it hits 1700, it will give you a notification. That could be a good idea. If you want to put a DBS of 3% chart, you put that trigger or alarm there, that it will notify you whenever a DBS is. That could be a good idea.
Yeah.
That I follow. Sentinel is one thing that I follow.
So, Saket, any other momentum strategy? I understood your overall. If we have to summarize your principle of the things that you are following, one is you are looking for the quality company, looking for the low volatility stocks, and then you are looking for technical filters in those in that universe, basically.
Yes, sir. Yes.
And any other momentum strategy or any other strategy also that you follow, or you are just sticking to this process?
So basically, first I follow this strategy. Then what I've done is, there is a factor called size factor. Basically, I've seen it in the US. There's a factor, size factor, where you invest in the top market cap companies. Basically, Nifty 50 is a size factor, you can say. So what I did was I backtested a strategy based from 2000 to 2020, 20-year backtest I did. Nifty 50, what we do here in the strategy is we take out the constituents of Nifty 50, we buy the top 10 companies of Nifty 50 every year, January 1st. And then we close our broking app that day. January 1st we buy, we close. Again on December 31st we will open the tab. And December 31st, Nifty, that is NSE indices, will release a new fact sheet of Nifty for the next month, January next year month. And then we see the top 10 stocks, then we rebalance it. So basically, we are playing Nifty 50 top 10. We invest only top 10 stocks of Nifty. So I did this over 20 years. What I've seen was volatility was less than Nifty. Returns were 6% higher than Nifty. There was good alpha over the index, around 16% CAGR from 2000 to 2020. But I'm not invested in the strategy so far. I just backtested it, both for Nifty and Nifty Next 50. Nifty Next 50, the results were satisfactory, but the volatility was too much. So I did not go for Nifty. 50 is a good strategy, the top 10 strategy. Basically, you open your app only once in a year and you do it. I've written a blog also on it, but it's a good strategy, but I'm not invested in it.
Nice to know, Saket. And good thing is, see, you are still, I mean, you have just started, you are very young, you'll learn a lot of new things, and there will be a lot of new strategies that you will follow, build. So I can definitely see a very bright future, just that you stick to these processes. And overall my experience has been, once you become very organized, you are a process oriented, I think that that is a key thing for the consistent and long term results. There are so many tools, endless strategies, all kinds of branch of analysis. The one good thing that I found, that you are following a process for fundamental analysis for picking the stocks. You're also looking at technicals. You don't have that kind of a barrier that you'll just stick to one particular thing. And that is what I think more sensible. Whatever makes sense to you, whatever you can follow, you should do that. Basically, that should be the approach. And that I find in you that's very good to see.
Thank you. Thank you very much.
So Saket, wish you all the best. Thank you very much for sharing your process strategy. I am sure that our viewers will definitely enjoy that, and they've learned a lot of things from you. I've learned many things from you, and I truly enjoyed this interaction.
Thank you. Thank you very much. It's an honor speaking at the Definedge EDECMA. Thank you very much.
Yes. Thank you, Saket.
Thank you, sir.